everyone. Welcome to the show. I'm your host, Caitlin Cormier. One of the many questions investors may be asking themselves in 2023 is, how can I earn extra yield from my portfolio? Inflation remains stubbornly high and acts like an invisible tax on our investment returns. Well, one way to potentially earn some extra income is by selling options. Options are contracts that give a buyer the right to buy or sell a stock from the seller at a predetermined price and time frame. The option seller collects a premium, but in exchange, they'll have to fulfill the contract if the buyer exercises their right. The income from selling options can add up over time and help investors fight back against inflation. But of course, as with everything in life, there's no such thing as a free lunch. Trading options can take a lot of time, effort, knowledge, and budget. So some investors might not be comfortable trading options for themselves. Instead, they could consider funds that employ options trading. Let's hear about some of the approaches these funds might take to trading options and some of the potential benefits and risks to consider. Joining us is Richard Ho, Vice President of ETF Distribution at BMO Global Asset Management. Richard, thanks for taking the time to chat.
Hi, Caitlin. Thanks for having me here.
Can you share a little bit about what you do in your role at BMO?
As you know, my previous job at the exchange at TMX, I was an options specialist for 16 years in the field. Now at BMO ETF, I'm using that knowledge to help investors and financial investors, advisors, how to use option strategies and how they work in an ETF wrapper.
All right, we've got an expert with us today, so excited for the rest of our conversation. How have you seen interest in options trading funds change in recent years, particularly given all the economic uncertainty that we've had?
Well, absolutely, Caitlin. If you follow the news, you have surely seen that the option exchange volumes have exploded over the past years, especially during COVID, during the lockdown. Lots of do it yourself investors have become more hands on with their investments. And also, this led to massive content creation about options trading. Many investors have taken interest in either doing options themselves or invest in option-based ETF, strategies. So to put things into perspective, in 2022, option strategy ETFs welcomed $4.2 billion of net inflow, and this was the highest record in history.
All right. So let's get started with understanding a little bit more about why investors actually want to gain exposure to options trading in their portfolio. So we hear it's popular. So tell us a little bit about why investors might want to do that.
The reason I would say is that options trading is another tool to help investors reach their investment need for income and growth. This applies to retirees and also investors who are looking for a solution that offers sustainable and stable distributions and cash flow into the portfolio. So, for example, a covered call strategy can enable investors to generate additional income regardless of what the broader market conditions are. In a higher inflation environment, the 60/40 portfolio is not delivering the expected returns that investors used to get. And traditionally, investors relied on two sources of income: dividends, interest to supplement their need for income. But now, because we are using the options market, we can leverage what we can obtain from selling calls, selling puts to harvest that additional income by using these option strategies.
All right. And high inflation is certainly something that investors nowadays are aware of, certainly the environment that we are currently living in. All right, Richard, some in our audience might not be as familiar with how an option trade is executed. Can you explain kind of the A to Z mechanics of how an option trade goes through?
So, Kaylin, in the options market, you have two option types. You have call options and put options. So let's first talk about the call options. Now, just like in any trade, you have a buyer and seller. So you have a call buyer who pays to buy the option. When you buy an option, you pay the option premium, right? The option premium is the price of the option. So the call buyer pays the premium to buy this option, and this option premium is given to the option writer, also known as the option seller. Now, by buying a call option, you have the right to purchase the underlying stock or the security at a predefined price, which we call the strike price. Okay, so essentially, you are locking in, you're securing yourself a purchase price of that stock. Now, this option is a contract which has a predetermined expiry date. So the call buyer, the one holding that call option, has the right to use his option to purchase the stock at the strike price before this option expires. Now, going back to the call option trade, okay, let's say the market goes up beyond the strike price. The call buyer will benefit from this trade because the call buyer can purchase the stock at the strike price, which is going to be lower. So the call buyer can decide to do two things. First, either sell the call back into the market and close the position and take the profit, or exercise the call option by notifying his or her broker. Now, by exercising that call option, the buyer will need to have sufficient funds to acquire those shares at the strike price. The call writer, okay, since the counterparty has decided to exercise the option, the call writer will have to deliver the shares to the call buyer at the strike price, and the trade is done. Now let's talk about the other option type, which is the put options. The put option concept is relatively the same thing. You have your buyers and writers on the other side of the trade, but the concept is different because a put buyer thinks that the stock price is going to go down. So the put buyer will buy a put option to secure a selling price. Okay, the secured selling price is what we call the strike price. So if the stock market goes down, the put buyer will be able to sell the stock at a higher price than prevailing market prices. Now, if the put buyer decides to exercise this put option, then that means that the shares, the underlying shares, will be put to the put writer at the strike price. And this means that the put writer will be in the obligation to purchase the stock at the strike price.
Why might investors decide to invest in a fund that employs option trades rather than trading options directly?
Well, Caitlin, there's nothing wrong about investors wanting to trade options themselves because I've personally have done it in the past. But let me tell you this, it can be very time consuming because you got to do your due diligence, your company research, sector analysis, figuring out the entry and exit points. And then after, you have to do risk management. And looking at the option chain, you got to go through like all the different strike prices and figuring out, okay, which strike price am I going to use? And then after that, you have to decide on the expiry. You have to make sure that the expiration of the option that you're using is appropriate. And when it comes to trading, put on the trade, you have to evaluate whether or not the option premium makes sense. And the list really goes on. In my opinion, investing in an option-based ETF could take that execution risk off the investor's plate, giving them exposure to the same pros and cons of options trading. I always like to compare this to, for example, doing your own taxes versus hiring a professional accountant. For sure, you can do your own taxes, but are you confident that you are maximizing your filings and making sure that you get all the tax credits that you're entitled to? So just food for thought.
Okay, very, very interesting. So basically letting a professional handle it versus you having to do kind of all that legwork and research. I like that analogy. That's a good one. Okay, so let's explore some of those option trades that funds might employ to generate income. But just before we do, a reminder to our viewers that you can learn more about the basics of options trading in our video series, Using Options for Beginners. You can find it in the Learning Center on Webroker and on TD's YouTube page. Okay, the first option trade a fund might employ is selling covered calls. You've alluded to them a little bit, so let us know, how does that work?
So the investor will go out there and buy 100 shares of a stock, and then they'll write a call option on those shares to generate additional income. And the reason why we call this strategy a covered call strategy is because the investor is using the equity position as collateral towards the obligation to deliver the shares if ever the call option is assigned. Now, because the option writer has collected that option premium, the obligation to deliver the shares is always there during the lifespan of that call option. Now, the call buyer, let's think about the call buyer. The call buyer will make a profit if the stock price goes up beyond the strike price, because the call buyer has the right to purchase the stock at the strike price. And if the stock price goes up, most likely the call buyer will be able to purchase the stock at a lower price than the prevailing market prices. Now, on the other hand, let's say the option writer, gets assigned. The option writer is covered because he or she has the underlying stock to deliver the shares. Now, even if the option writer gets assigned, the option writer gets to keep this premium. This premium is additional income generated for the investor into his or her portfolio. Now, in the options market, the option premiums vary depending on the option moneyness. Some options are in the money, at the money, out of the money. So let me take a moment to explain what these terms mean, right? When the stock, let's say, is trading at $50, an at the money call option will have a $50 strike. And if the call option has a strike price lower than $50, those options will be what we call in the money. Now, any call option that has a strike price higher than the current market price of the stock, these options are what we call out of the money. Okay, so out of the money call options will give you a potential price appreciation, because if the stock price goes up and that you get your shares called away at the strike price, you're collecting additional income, but you're also trading away some of the upside because you're taking on that obligation to deliver the stock at that strike price. So, Caitlin, what I just explained is a traditional covered call strategy. However, in a covered call ETF, we tweak that traditional version and cover about 50% of the holdings. And what I mean by this is that instead of selling calls on the entire portfolio, most covered call ETFs, they'll sell maybe 50%, 30%, or 25% of the holdings. And what the benefit this provides is that, let's say if the market legs up, the portfolio will still be able to profit from that upside because only half of the portfolio has been written calls on.
So then what are some of the potential benefits and risks for an investor that holds a fund that's selling covered calls?
When we look at the covered call ETFs, the distribution yield that you are going to get versus a traditional index or dividend ETF will be a lot higher because of the option premiums that we are collecting. And this higher distribution is beneficial for retirees and also investors who need that extra income. The other benefit I would say is that a covered call strategy by nature, it helps reduce volatility in your portfolio, because selling call options and those call option premiums that you're collecting will be considered as additional income to the account and also help you offset any potential losses should the share price drop. So Caitlin, now on the potential risk side, I think one of the key risks in writing covered calls is the opportunity cost. If you're using at the money options, yes, you're going to be able to collect maybe a higher premium, higher distribution yield. But what this means is that there's a very high chance that the call option that the fund has written or sold on will be assigned. If they're assigned, what happens next is that the fund needs to write other options to keep that distribution going. And that ultimately will increase the frequency of trading in these funds. And when the frequency of trading increases, This will ultimately increase the trading expense ratio, the TERs. The other risk, Caitlin, that I find that investors should be, cautious about is the fees. For example, we see that some of the ETFs are using what we call fund of funds. So what a fund of fund basically is that it is an ETF that goes out there and purchases cover call ETFs from third party providers, from other providers. Now, because they're buying a basket of different ETFs, what happens is that this gives them the opportunity to double charge fees on top of the fees. So although the website might be showing, a management fee of 65 basis points, if you take a closer look at the MERs, the management expense ratios, it could be north of 2%. Okay, so for investors, it's very important to know exactly what the ETF provider is charging you. Because at the end of the day, the total cost of ownership is what you are paying for, not just the management fee.
The next options trade that a fund might employ is selling cash secured puts. So, how does that work?
By buying a put option, it gives the option buyer the right to sell 100 shares of the underlying stock at the strike price before the option expires. Now, on the other side of this trade, the put writer is collecting this option premium. But in exchange, the put writer will have the obligation to purchase the shares at the strike price should the option get assigned. Now, put buyers typically will exercise their put option is when the stock price goes down. And when you're talking about, let's say, for example, a cash secure put, you are selling put options and putting sufficient funds aside as collateral in case the put options are assigned.
What are the potential benefits and risks for an investor holding a fund that sells cash secured puts?
The strategy is designed for investors looking for consistent and tax efficient income. All the option premiums collected from the put right strategy is paid out monthly to investors, which could boost the total return during bull markets or even help offset some of the losses during a bear market. Now, another benefit with a put right ETF is that you get paid while you wait. They're not just selling put options on just any single stock out there. Okay, the ETF is constructed and they go through a very rigorous technical and fundamental screens. So this allows, lower exposure to the downside systematic risk. Now let's talk about the potential drawbacks in a put right strategy, the risk. So let's imagine we're in a bullish market. The put options that are written in the fund will not be assigned because the stock price keeps on going up. And what happens in this situation is that the fund will only benefit from the premium yield on the puts that were written and not be able to take on any of that price appreciation on the underlying stocks. Another thing that investors should know about the risk of using put right strategies is the downside equity risk. And what I mean by this is that there could be, let's say, there's a significant market correction during the lifespan of the put option. The puts will be assigned. And once the puts are, the assignment is triggered, the fund manager or the fund would have to purchase these stocks at a much higher price, i.e. the strike price. And this price will be a lot higher than the prevailing market prices.
All right. There are also funds that sell both covered calls and cash secured puts within the same portfolio. So, what are some of the potential benefits and risks with this approach, kind of the combo of the two?
So the combo of the two, covered call and cash secure put strategies in an ETF is what I like to call an alternative income solution, but they can also go by different names. So generally speaking, these alternative income ETFs employ an option strategy similar to what traders like to call the wheel strategy. The goal of the wheel strategy is to create a steady stream of income on a basket of stocks that the portfolio manager is comfortable holding for the short, to medium term horizon. Now, the reason they call this the real strategy is because it involves selling cash secure puts on a basket of stocks and collecting premium along the way. Now, if the put options that they are selling gets assigned, then they'll purchase the stock at the strike price. And this acquisition is actually subsidized because remember, when you first start off with this trade, you are selling put options and you're collecting that option premium. So this option premium that you're collecting can help you subsidize that acquisition cost during assignment. Now, once you have the shares, what the fund will do next is that it will sell calls against them, against the shares that they are holding by using a cover call strategy. Again, they're collecting call option premiums along the way, generating higher yield, higher distribution. And these calls, if ever they get assigned, then they'll sell the shares, deliver the shares at the strike price, and hopefully collect a profit across the totality of the trade, from selling the puts to start and then selling the calls to end. And then they'll recycle and continue the cycle over and over again between a cash secure put strategy and a cover call strategy.
And if history is any guide, what sort of market environment might each of these option trades that we discussed work best and worst?
Kaden, that's a good question, and I get that asked a lot. And let's start with the cover calls. Cover call strategies tend to outperform a buy and hold strategy during, let's say, 3 out of 4 market conditions. And these are sideways markets, moderately bullish markets, and bear markets. And the reason this is because the option premiums collected from writing these options are helping you offset some of that stock price decline, right? Now, however, a cover call strategy will tend to underperform during strong bullish markets. This is because the options are going to be in the money and the options are going to be exercised by the call buyers. The gains from collecting option premiums would be less from the gain that the investor would have made by just buying, holding the stock. But in a cover call ETF, since in the industry it's about 25 to 50% of the portfolio that are covered, so these strong bullish market upswings to the upside will not be as impacted as a traditional cover call strategy. Now, as for a cash secure put strategy, they tend to have the same tendencies to outperform a buy and hold strategy during the sideways markets. And in, let's say, moderately bullish markets, they would tend to market perform. And this is because the premiums collected from the put options help add additional income to any stock gains. However, the performance may be mixed in a strong bull market, given that the put option buyers wouldn't exercise their put options and therefore the fund would be able to acquire the underlying asset. In a cash secure put, this strategy would tend to underperform a buy and hold strategy during bear markets because in a bear market, the chances of the puts being assigned are higher as the share prices go down. So depending on the intensity of the share drop and also the premiums collected from selling the puts would unlikely be enough to offset any of that capital depreciation. And last but not least, the wheel strategy, well, it tends to outperform a buy and hold strategy during sideways markets and also bear markets. It'll market perform, I would say, in a moderately bullish market. Now, this is because the trader would collect premiums that would add to the performance of the underlying shares, while the calls and puts would likely not be exercised as often if the market is flat. However, the wheel strategy tends to underperform a buy and hold strategy during very bullish markets. And this is because, the calls would be likely to be in the money. And if that's the case, the calls would be exercised and the put options would expire out of the money.
All right. Thanks for walking us through those 3 approaches that option funds might employ and the potential benefits and risks of each. How do the fees on options funds generally compare to the industry average?
Caitlin, that's a good question. With the infrastructure and the proactive option management behind the scenes, the management fees on option rating ETFs are typically between 65 to 85 basis points in the industry. In the option based ETFs, it involves active management from the fund managers. So these fees could be slightly higher than passive ETFs. Management fees can be influenced by how actively options are written. So remember when I was talking about the cover call ETFs that uses at the money options? At the money options would someone involve a more active trading? Okay, because it's using at the money options, it requires the fund to consistently roll their positions to at the money ones. So that would increase trading costs, increase the TERs, which is the trading expense ratio. So again, I always like to tell investors to check the provider's website and look at the ETF fund perspectives and understand and see what the breakdown of all the fees.
Okay, some great tips to consider there when looking at fees for these types of funds. Some things to keep an eye out for. What are some of the factors that might influence the performance of an options trading fund, particularly during times of economic uncertainty like we're experiencing in 2023?
One of the factors to consider is that the option premiums are generally going to be higher during higher market volatility because option buyers typically pay a higher price to secure those options when markets are volatile. So, on the other side of the trade, if you're the option trader, these high volatile markets will be beneficial because you're going to be able to demand a higher option premium. Another factor to consider is that some sectors are more sensitive to the economic performance and interest rate policies than others. So, for instance, the tech sector, they may rely on the revenue growth and business expansion to justify their share price. Therefore, the higher borrowing costs in a higher interest rate environment could affect their balance sheet more severely and may hamper their ability to grow. So holding an ETF that writes cover calls on technology stocks might see more volatility, more volatile returns than an ETF that writes cover calls on utility companies.
All right, thanks for walking us through some of the ways investors can gain exposure to options trading through fund products. We're going to have to leave our conversation there, but before we go, let's hop into Webroker to learn one way to screen for options funds. We're going to go ahead and create a custom screen to find specific ETFs that match the criteria we're looking for. So we're going to go under Research, then Tools, and click on Screeners. Once we get to this page, we're going to go ahead and click on ETFs. And so a screener, in case you're not familiar, is where we're going to take all the ETFs that are out there on the market and we're going to go ahead and filter them down based on our own specific criteria. So I've clicked create a custom screen here and we're going to actually go through and choose some specific criteria we'd like to search based on. First of all, we're going to click only Canadian ETFs because that's already listed for criteria. And we're going to go ahead and unclick mutual funds because we are looking at ETFs today. Next, I'm going to choose fund category and click add to criteria. And I've got a few different categories I'm going to add here today. I'm going to start with alternative equity focused. And then I'm going to choose Canadian dividend and income equity. And then I'm going to go ahead all the way to the bottom and choose Canadian US equity because we are alphabetical here. And then the final one I'm going to choose is Canadian miscellaneous income and real property. Just scroll through here. There we go. All right, next up, I'm going to go ahead and choose management expense ratio. Now, I'm not going to filter in any way by MER. I'm just going to have it listed there. And again, that would be the cost of holding this ETF, the management expense ratio. Next up, I'm going to choose dividends, and I'm going to add both distribution yield and frequency. And I'm just going to scroll down and I'm going to choose above average and the highest distribution yield. And I'd like to see monthly distribution frequency. So as we can see here, we've gone from 1,229 Canadian ETFs, and based on our screening criteria, we're down to 54 matches. So let's go ahead and view those matches. As we scroll through here, we can see all of the different ETFs that match that criteria, and we can see all of the different criteria we put in, and we can actually rearrange these results based on the criteria. So if I wanted to see what category these ETFs fall under, or based on NER, or maybe I want to see the highest distribution yield, I just click on distribution yield twice and it rearranges it based on that information. I can also go ahead and see there's a bunch of tabs at the top that I could click on to see additional information about these funds. So I've clicked on performance and I can do a comparison here. I could also click on profile, again, see the fund inception and that sort of thing compared side by side. And finally, if I've gone through here, I found some different funds that I want to do a bit more research on, I can go ahead and choose up to 5 different funds and then click the compare button here and actually see them directly side by side and be able to do a comparison. Finally, important to always save the screen so that you have it to come back to in the future. So what I'm going to do is I'm going to go ahead and name this one May 2023. So make sure you put the name in first and then click Save Screen. And then the next time that you come back to Research, under Tools and Screeners, you'll be able to see under ETFs, your newly saved screen. So we'll just look for May. There it is, May 2023. I can view matches and I'm already back to that screen. Okay, Richard, any final thoughts you'd like to share with our viewers?
Sure, Caitlin. In my opinion, a cover call ETF is simply one of the greatest innovations that combine the equity and options market together in an ETF wrapper, also making it cost effective for investors looking for additional income. I find that every ETF provider has its own way of writing cover calls in their mandate. Just make sure that you understand how they come about with these distribution yields because, like you said, there is no free lunch in the market. And stick with providers that have a proven track record that you can trust. So, as a good exercise for the viewers today, they should go and visit the ETF provider's website and see what options they are writing on. And being able to look at the entire holding is very important. Aside from that, I hope I answered all your questions today, Caitlin.
That was a great summary of our conversation. Thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.